Something strange is happening beneath the surface of the global financial system, and most people don't see it yet. While markets look calm on the outside, pressure is building inside gold, silver, and bond markets at the same time. This is not normal. These three rarely flash warning signs together unless something bigger is breaking. And this time, the trigger isn't just economics. It's US debt colliding with geopolitical conflict. And the shockwaves are already moving through the system faster than most investors realize. Before we go any further, if you want clear, no-nonsense breakdowns of global money shifts, debt cycles, and power politics like this, make sure you like this video and subscribe to the channel. Here on Let Fin and Ass, we connect economics with real-world events so you can see risks before they hit the headlines. Subscribing now helps you stay ahead instead of reacting late. Let's start with the uncomfortable truth no politician wants to say out loud. The United States is drowning in debt, and it's accelerating. Trillions are added, not over decades, but over months. Interest payments alone are exploding, and that means the government has to borrow even more just to stay afloat. This creates a dangerous loop. Issue more bonds to pay old bonds, raise rates to control inflation, then issue even more bonds because interest costs rise again. At some point, confidence cracks, and when confidence cracks, markets don't move slowly, they snap. Now, here's where bonds come in. US Treasury bonds are supposed to be the safest asset in the world. They are the foundation of global finance. Banks, pensions, insurance companies, and even foreign governments hold them as collateral. But recently, something unusual has been happening. Big players are selling. Not panicking, not dumping overnight, but quietly reducing exposure. When bond prices fall and yields spike at the same time the government is issuing record amounts of new debt, it creates a supply problem that demand can't keep up with. At the same time, geopolitics is making this worse. The US is involved directly or indirectly in multiple global conflicts. Sanctions, trade restrictions, asset freezes, and political pressure have changed how countries view dollar-based assets. When reserves can be frozen with a signature, trust disappears. That's why more nations are asking a dangerous question. Why hold US debt at all? And once that question spreads, the bond market starts to lose its anchor. This is where gold enters the picture. Gold isn't just a shiny metal, it's a signal. When central banks buy gold aggressively, they're telling you something without words. Over the past few years, central bank gold purchases have surged to levels not seen in generations. These aren't small countries either. We're talking about China, Russia, and others who clearly want protection outside the dollar system. Gold has no counterparty risk, no sanction risk, no default risk. And when debt looks unstable, gold becomes insurance. Silver, however, is even more interesting and more dangerous for the system. Silver sits at the crossroads of money and industry. It's used in electronics, solar panels, military tech, and energy infrastructure. When geopolitical conflict increases, industrial demand for silver rises. When debt risk increases, monetary demand for silver rises too. That double pressure is rare, and when it happens while inventories are thin and supply growth is limited, price volatility can explode. What makes this moment different from past crises is timing. In 2008, bonds were trusted. In 2020, money printing was accepted. Today, we're facing debt overload, geopolitical fragmentation, and inflation fear all at once. Bonds are no longer the unquestioned safe haven. That pushes capital toward hard assets. But even hard assets are stressed because they are being pulled in two directions: financial protection and real-world use. Now imagine this scenario. A major geopolitical escalation forces governments to spend more on defense, energy security, and supply chains. That spending is funded with debt. More debt means more bonds. More bonds mean higher yields. Higher yields break parts of the financial system that rely on cheap money. To stop the damage, central banks step in, but stepping in means printing, or at least monetizing debt. That weakens currencies. And when currencies weaken, gold and silver respond violently upward. This is not theory. This is how every major debt cycle ends. The reason this matters to everyday people is simple. When bond markets wobble, pensions wobble. Mortgage rates jump. Credit dries up. When gold and silver surge, it's not because life is getting better. It's because trust is breaking. Markets don't price happiness. They price risk. And right now, risk is being repriced across the system. Another layer most people miss is how interconnected everything has become. Banks hold bonds as assets. Bonds fall, bank balance sheets weaken. Banks tighten lending. Businesses slow hiring. Consumers pull back. Governments respond with stimulus. Stimulus increases debt. Debt pressures bonds again. It's a feedback loop that feeds on itself. And geopolitics adds fuel by making cooperation harder and fragmentation normal. This is why you see so much quiet movement by institutions. Not loud predictions, not dramatic headlines, just repositioning. Shorter duration bonds, more exposure to commodities, strategic gold accumulation. These moves don't show up immediately on your screen, but they show up later as unexpected market events. By the time the public notices, the easy exits are gone. Here on Kevinomics, The goal isn't to scare you, it's to help you see patterns early. Gold, silver, and bonds flashing warning signs together is not a coincidence. It's a message. A message that the current system is under stress from both inside and outside. Inside from debt and deficits. Outside from geopolitical conflict and loss of trust. As this plays out, volatility will not be an exception. It will be the norm. Calm markets will become shorter. Sudden moves will become sharper. And narratives will change fast. One week, it's soft landing. The next week, it's unexpected shock. That's how late-stage cycles behave. Smooth until they are not. If you've watched this far, you already understand this is bigger than one asset or one country. It's a global adjustment happening in real time. Drop a comment below and tell me what you think breaks first. Bonds, currencies, or geopolitics themselves. Share this video with someone who still thinks everything is normal, because conversations like this matter before the headlines force them. If this breakdown helped you see the bigger picture, make sure you share it and stay connected with Let Finance. The next phase of this story is already unfolding, and the people who understand it early will always be better prepared than those who find out after the shock hits.